Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at HIMS and HERS Health.
If you find our talks useful, please consider subscribe, like, and comment underneath.
It really helps the algorithm find us.
It really does. So let's just unpack this right away, because the timing here is absolutely critical for you listening. Today is Sunday, February 22nd, 2026.
Right.
And I want to be very clear about that date because we are sitting right on the razor's edge of a massive event for this company. They report their fourth quarter and full year earnings tomorrow morning, Monday, February 23rd.
Exactly. This is one of those moments where the market is collectively holding its breath. We have a mountain of data to get through today, and the context here is fascinating because the price action recently has been, frankly, it's been pretty confusing.
Confusing is putting it lightly. I'd call it a paradox. I mean, this is a retail favorite, right? You go on Reddit, you go on X, and people are just obsessed with this brand.
They really are. They love the marketing.
Right. They love the product, the whole aesthetic. But if you look at the chart, it's been a horror show. The stock has dipped nearly 56% over just the last 3 months.
It's become a total battleground stock.
Completely. And that disconnect
Between the popularity of the company and the violent sell-off.
Exactly. That disconnect is what makes this particular analysis so important for you to understand. Because usually when a stock drops 56% in a single quarter, you expect the underlying business to be falling apart.
You expect revenue to be shrinking, customers fleeing.
Or the CEO is under investigation or something.
Right. But with HIMS and HERS, we are seeing the exact opposite.
Right. And that's the puzzle we're trying to solve today. The business seems to be on fire in a good way, but the stock is in the freezer. So the question for everyone listening is this a massive buying opportunity, like a fire sale before the earnings drop tomorrow?
Or is the market seeing a fatal flaw that the retail investors are completely missing?
That is the question. And I think to answer it, we have to start with the fundamentals. We have to look at the growth engine itself. Because despite what the stock chart suggests, the growth numbers are, well, they're undeniable.
They really are.
Let's get into those numbers. Take us back to the last reported quarter. What did they actually put on the board?
So in Q3 of 2025, they reported revenue of $599 million.
Okay.
That is up over 49% year over year.
Nearly 50% growth. That is not a company in decline. That's hypergrowth territory.
Not at all. And it's important to note for you listening that this wasn't just a one-off lucky quarter. If you look back at Q2 of 2025, revenue was up 73% year over year.
Wow.
Yeah, hitting $544.8 million. And here is the kicker. They posted solid net income of $42.5 million.
Okay, let's pause there for a second because that is a crucial detail. Usually when we talk about high-growth tech or telehealth companies, the story is growth at all costs, right?
Yeah. Burn cash to acquire customers.
Exactly. They grow revenue by 50%, but they lose money on every single transaction. They burn furniture to heat the house. You're saying HIMS and HERS is growing at 50% and they are actually profitable.
Yes, and that is what separates them from the pack. Right now, they are generating real cash. In Q3, their adjusted EBITDA was over $78 million.
For the listeners who don't live in spreadsheets every day, let's clarify that. Adjusted EBITDA is basically a proxy for cash flow from operations, right?
Exactly. It means the core business is self-sustaining. They can fund their own marketing, their own research and development, their own expansion.
Which is huge.
It is. They don't need to go out and raise debt with high interest rates, and they don't need to dilute shareholders by selling more stock just to keep the lights on. It gives them total control over their own destiny.
Which is such a massive advantage in this economic environment. If you can fund your own expansion, you don't care what the Federal Reserve does nearly as much as the unprofitable guys do.
Yeah.
But I have to ask, what is actually driving this? Because for the longest time, I just thought of this company as the place you go for, well, hair loss pills and maybe some ED medication. Is that still the main story?
It's definitely the foundation. It pays the bills. But it's no longer the whole story. The engine has evolved significantly. Right. That surge in revenue is heavily fueled by strong subscriber growth. They've got over 500,000 subscribers now. But the real accelerant, the thing that poured gasoline on the fire, has been the demand for weight loss treatments.
The weight loss gold rush, the Ozempic effect.
Exactly. Specifically, compounded GLP-1 medications. They tapped into that market at the absolute perfect time, and it has driven a massive amount of volume to their platform.
Okay, we need to unpack compounded GLP-1s because this is a bit controversial and it's really important for the risk profile we're going to talk about later. These aren't the brand name pens you see in the Super Bowl commercials, right?
Correct. And this is a very critical distinction. When a drug like Wegovy or Ozempic is on the FDA's official shortage list, meaning the big manufacturer, Novo Nordisk, literally cannot make enough to meet demand.
Right.
Regulations allow compounding pharmacies to mix the active ingredients themselves to fill the gap in the market.
Okay.
HIMS and HERS partnered with these facilities to offer the medication. It's cheaper, and more importantly, it was actually available when the brand names were sold out everywhere.
So they capitalized on a shortage. They saw a window where people were desperate for these drugs and the big pharma companies couldn't supply them, so HIMS stepped in as the supplier.
Precisely. And it brought a whole new demographic to their site. People who might never have clicked on a hair loss ad came for the weight loss, and now they are in the ecosystem.
That makes a lot of sense. So looking ahead to tomorrow, because that's what everyone listening cares about right now, what is the guidance? What is Wall Street expecting to see when those numbers drop?
For tomorrow's Q4 report, the guidance is for revenue between $605 million and $625 million.
Okay.
That would represent about 26 to 30% growth. And for the full year, they are targeting around $2.35 billion in revenue.
$2.35 billion. That is a serious chunk of change. That takes them out of the niche website category and puts them firmly into major healthcare player territory.
It does. And remember, because of that cash flow we talked about earlier, they aren't just sitting on this money. They are reinvesting it aggressively. In fact, they just made a massive move that I think a lot of people haven't fully digested yet.
You're talking about the acquisition. They went shopping.
They went big game hunting. They announced the acquisition of a company called Eucalyptus.
Eucalyptus sounds very calm and soothing. The price tag, however, was not small.
No, it is a $1.15 billion deal.
Over $1 billion. That is a bet the company kind of moved. So what did they buy? Why spend that much money on a company that, honestly, nobody in the U.S. has really heard of?
Because Eucalyptus is essentially the HIMS and HERS of Australia and Japan. By buying them, they instantly opened up those two massive international markets.
Why buy, though? Why not just launch HIMS Japan? Just translate the website, hire some local doctors, and go. Why spend over $1 billion?
Because healthcare is incredibly local and culturally specific. Japan, in particular, is a very difficult market for Western health companies to crack. The regulations are a maze, and the consumer trust dynamic is totally different.
You can't just copy-paste an American marketing strategy into Tokyo and expect it to work.
Exactly. Buying Eucalyptus, which was already winning in those regions, is a shortcut. It saves them 5 years of struggle and regulatory headaches.
So they bought a turnkey operation. They bought immediate access.
That's it. It's a geographic leap. It instantly makes them a global platform rather than just a U.S.-centric one.
I want to connect this back to something we talk about a lot on the show, the moat. Because one of the criticisms of this business model has always been, okay, you sell pills online. What stops Amazon from doing it? What stops a traditional doctor from doing it? How does buying Eucalyptus or selling weight loss drugs actually protect them from competitors like Ro or Amazon Clinic?
It comes down to what management calls their personalized digital health platform. I know that sounds like corporate buzzwords, but the concept is really sound. The moat isn't the pill itself. It's the ecosystem and the high switching costs.
Explain that for the listener.
Well, think about Apple. You get the iPhone, then you buy the watch, then you have all your photos in iCloud. It becomes a huge hassle to leave. HIMS is trying to do that with your body.
Right.
Once you are in the system and you have your medical history log there and you have a treatment plan that is actually working,
right,
and the doctor knows your profile, you're way less likely to leave just to save $3 at a local pharmacy.
It's sticky.
Very sticky. And they are deepening that retention by expanding into entirely new medical verticals. They aren't just doing the somewhat embarrassing stuff anymore, the ED and hair loss. They are moving into genuine preventative care.
Like what? Give me an example.
They have a partnership regarding Gallery, which is multi-cancer early detection testing.
Wait, cancer screening? That's a huge leap from hair loss foam.
It is, and it's highly significant. It's a blood test that can detect over 50 types of cancer. They're also moving into menopause treatments and low testosterone or low T testing. The strategy is to use AI to drive preventative care.
So the vision is I open the app and it's not just a place to buy a pill, it's a comprehensive dashboard for my health. It tracks my weight, my hormone levels, and tells me if I need a cancer screen.
Exactly. And if a customer relies on them for weight management, hormone health, and cancer screening, they aren't going to switch providers easily. They're building a relationship where they become the primary touch point for your entire health profile.
That makes total sense. It shifts the valuation model from an e-commerce store to a true healthcare platform. But, and there is always a but in these scenarios,
What?
if everything is growing so fast, if the revenue is up 50%, if they are buying companies and expanding globally, why did the stock drop 56% in 3 months? We have to play devil's advocate here. What is scaring the market so badly?
We have to address the elephant in the room. And it's a 500-pound gorilla, honestly. It's the legal risk. Specifically, the Novo Nordisk lawsuit.
Okay, let's break this down. Novo Nordisk makes the brand name weight loss drugs Ozempic and Wegovy, and they're suing HIMS and hers.
Correct. The lawsuit targets compounded semaglutide. Novo Nordisk is fighting back hard, arguing that these compounded versions are infringing on their rights or, in some cases, aren't safe or being marketed deceptively.
And since we just established that GLP-1s are a huge part of their recent growth, the fear is that a judge could bang a gavel and shut down that entire revenue stream overnight.
That is part of the fear, absolutely. But there is a second layer to this risk that is maybe even more likely than a lawsuit loss. It's the regulatory risk regarding the shortage itself.
Right. We said earlier they can only legally sell this stuff because there is an official shortage.
Exactly. If the FDA comes out tomorrow and says, great news, the shortage is over, Novo Nordisk has caught up with demand, then legally, the compounding pharmacies have to stop making the copycat versions immediately.
So the revenue from weight loss could literally go to zero in a day if the shortage ends.
That is the nightmare scenario for investors. They look at that 50% growth rate and ask, how much of that is just temporary shortage money? If that engine stalls, the stock suddenly looks very expensive.
That explains the fear perfectly. Is there anything else weighing on the stock, or is it just the lawsuit and the potential end of the shortage?
There's a secondary risk as well, margin compression. In Q3, their margins actually contracted a bit.
Meaning they are making less profit on every dollar of sales.
Right. This was due to mix shifts. Basically, selling weight loss drugs is more expensive than selling hair pills. The margins are just lower. Plus, buying a massive company like Eucalyptus and integrating it costs a lot of money.
Yeah.
So there are worries that costs are rising just as their biggest revenue driver is coming under intense legal fire.
Okay, so the fear narrative is the weight loss gold rush hits a legal wall, and meanwhile, it's getting more expensive to run the core business. I can see why the stock sold off. That's a scary story to buy into.
It is a valid concern. But this is where we have to look at what the smart money is doing. Because often, retail investors panic and sell on the scary headlines, while the big institutions, the ones with armies of lawyers and analysts, they make their moves quietly.
So are the big players fleeing? Are they dumping the stock because of the Novo Nordisk lawsuit?
Actually, we are seeing a fascinating divergence.
Yeah.
While the stock price was falling so dramatically, some major institutional investors were actively buying the dip in Q3 2025.
Who are we talking about?
Farallon Capital, for one. They added 2.53 million shares. That was the 30% increase to their position.
Okay, that's a serious vote of confidence.
But the big one is T. Rowe Price. They added 2.5 million shares, which was a massive 444% increase in their holdings.
Wow, 444%. T. Rowe Price isn't exactly a day trading Reddit gambler. They are a conservative, long-term shop.
Precisely. You don't increase your position by over 400% if you think the company's about to be shut down by a lawsuit next week.
That tells me their legal analysts looked at the Novo Nordisk case and concluded it's manageable. Or at least that the risk is completely overpriced by the market.
Exactly. They look at that 56% drop and say, okay, the market has completely overreacted. Even if they eventually lose the weight loss revenue, the core business is still incredibly strong in generating cash.
They're betting that the company is undervalued at this price, regardless of the noise. What about the Wall Street analysts? The people whose job it is to put a price tag on this thing for the next year or two. Where are they landing?
It's a pretty wide range, which reflects all that uncertainty we just talked about. On the conservative side, you have Evercore ISI with a price target of $33.
$33. And where is it trading now?
Well, with the massive drop, it's significantly below that. So even the bear case offers some upside from these current levels.
Interesting.
Then you have Barclays at $48, BT is at 60, and the true bull case comes from Canaccord with a target of $68.
So if Canaccord is right and it goes to 68, we are talking about a massive multiple from where it is today. That's a double or a triple for anyone buying the dip.
Right, but current sentiment scores across the board are officially neutral. And that's largely because, as we said right at the beginning, everyone is just holding their breath for tomorrow's numbers. The market hates uncertainty, and right now we have maximum uncertainty.
So let's look at the timeline for you watching this. We've got the next 3 months. What are the specific catalysts that could move the needle here?
The immediate one is tomorrow morning. The consensus expectation is $620.4 million in revenue and earnings per share of 4 cents.
That seems, well, it seems beatable given their history of crushing estimates recently.
It does seem beatable.
Yeah.
And if they beat that, if they come in with, say, $630 million and offer strong guidance for 2026, that could cause an immediate re-rating. The market might suddenly wake up and realize, wait, this thing is way too cheap.
So there's a short squeeze potential there.
Definitely possible given the heavy negative sentiment recently. And beyond tomorrow, we really need to watch the integration of eucalyptus. If that goes smoothly, it completely validates their global strategy.
Right.
And then there's the broader macro picture. We are seeing a sector rotation back into telehealth. And with rate cut expectations from the Fed, growth stocks like this usually benefit because their future cash flows suddenly become more valuable.
Okay, so we've looked at the hypergrowth, we've looked at the legal risks, the big money flows. It's time for the verdict. How do you score this setup?
I'm going out on a limb here. I'm giving this an 8 out of 10 on the bullish scale.
An 8 out of 10. That is fairly high given the lawsuit risk hanging over them. Walk me through your final thesis.
Look, the revenue growth of 49 to 73%, it's undeniable. You rarely find that kind of sustainable growth trading at these depressed multiples.
True.
But the real key for me is the pivot. They are proving they are not just a GLP-1 shop taking advantage of a shortage. With the eucalyptus acquisition, they become a true global platform. With the AI diagnostics and the Gallery partnership, they become a comprehensive health monitor.
So you think the market is too focused on the weight loss drugs, the flavor of the month, and completely missing the bigger picture?
Exactly. The risk of a lawsuit is real. I'm not dismissing that at all. But the valuation compression we've seen, that 56% drop, suggests that the market is pricing it as if the company is going to zero. And they aren't. They are generating massive cash.
So your view is that the bad news is mostly priced in?
Yes. For the brave, it's a swing trade into the earnings volatility tomorrow. It's going to be a wild day, no doubt. But more importantly, it looks like a multi-year hold for the global growth story. If you believe they can replicate their U.S. success in Japan and Australia, the current price is a steal.
It's a fascinating setup. You have high fear, high growth, and deep value all mixed together in one stock. It's going to be a very interesting week.
Absolutely. And I have one final thought for you to really chew on before the market opens tomorrow. Think about the data.
The data.
We talked about them using AI. Imagine a world 5 years from now where HIMS and HERS has detailed health data on millions of people across 3 different continents.
Wow.
We're talking continuous hormone levels, weight trends, prescription adherence, cancer screenings.
That is incredibly valuable data.
It's the new oil. The value of that data set alone, for drug development, for academic research, for insurance modeling, might eventually be worth more than the current market cap of the entire company.
That's a huge point.
They aren't just selling pills anymore. They are aggregating human health data at scale. That is the hidden asset here that no one is talking about.
That is a massive thought to end on. We get so caught up in the PE ratio and tomorrow's earnings per share that we forget the value of the information itself. Something for you to mull over. Thank you for joining Smart Wealth with Joshua.
Thanks for listening.
As always, remember to do your own due diligence. Earnings are coming out tomorrow, so expect some serious volatility. Don't invest money you can't afford to lose. We'll see you next time.
Bye for now.